We're going to be talking about review exercise 9-3. And this exercise is talking about a liability that is created by coming up with an estimate. So in this case, we're going to be talking about property taxes. So it says C and Company's fiscal year begins on April 1st, and at the beginning of its fiscal year, the company estimates that it's going to owe $17,400 in property taxes for the year. On June 1st, its property taxes are assessed at actually $17,000, which it pays immediately. And we need to prepare the related journal entries for April 1st, May 1st, and June 1st, and then compute the monthly property tax expense that the company would record during July through March. So again, this is a liability that is generated because an estimate had to be made. And we have to record a liability for things such as property taxes that can be reasonably estimated, and we know that we're going to have to pay. GAAP requires us to record those. So the first one we'd have to record is on April 1st. We have estimated that through the entire year, we think our property taxes will be $17,400. So we're going to record a property tax expense for 1/12 of that value. So $17,400 in total, and we're going to divide it by the 12 months. So we have a $1,450 property tax expense. And this is a property tax payable for us as of April 1st because we haven't actually paid any property taxes. Remember, under the accrual basis of accounting, GAAP requires us to record expenses in the period that they're incurred, not when they are paid. And if we're using this property throughout the year, we're technically incurring a portion of that property tax expense every month. For May 1st, we'd have the exact same journal entry. We'd have our property tax expense for the $1,450 and our property tax payable. At this point, our $17,400 estimate is reasonable. We haven't been assessed, and we do not know our actual amount yet. However, that changes for us on June 1st. On June 1st, it tells us that we are assessed $17,000 in property taxes, which the company pays immediately. So we need to eliminate our property tax payable that we've created for the past 2 months of the $1,450 apiece for a total of $2,900. We now have a prepaid property tax because we are going to recognize a portion of that every single month, just like we would with prepaid insurance or prepaid rent. And that's the difference between the $17,000 that we are assessed and the $2,900 that we had already expensed this year, giving us a $14,100 prepaid property tax. And again, they told us that we paid that property tax immediately. We've paid the $17,000. They also asked us to calculate how much we would be recording from July through March in terms of property taxes. So from July through March, we would journalize the same entry. We would debit our property tax expense, and it would be for a portion of that prepaid value, so $14,100, and we would divide it by the 10 remaining months that we have from July through March. So each month we'd have a $1,410 expense, and we would reduce then our prepaid property tax by that same value.